Let's talk about SCHD. I'm not going to pronounce it because that might get me into trouble on YouTube, but you know what I mean. And if you don't, just go on YouTube, put SCHD in a search bar and you will see hundreds, if not thousands of videos almost every day coming up. It seems to be the latest craze these days and people really going heavy investing into that particular ETF. Same when we go on Google Trends, and I always like to check Google Trends for investing because you can see how the interest for a particular stock or company is either growing or declining over time. And when we put SCHD over here, I put worldwide, for the last 5 years, you can really see a nice upward trajectory. So people are really getting excited about this particular ETF. And while it is a US-based ETF, interestingly enough, there's also a lot of interest from South Korea, Israel, Singapore, Canada. And then you also find related queries. So it's always interesting. JEPI or YEPI, I don't know how they pronounce it, is yet another very popular ETF people are investing a lot of their money in. But today I really want to focus on SCHD because when I saw all these articles and videos coming out, myself also got quite interested and potentially wanted to invest into the ETF because everyone was talking about it, saw some great results. When you look at the 10-year returns versus the S&P 500, 219 versus 203, so very much similar performance over a 10-year period as the S&P 500, which is great, but it really focuses on dividends. In fact, that's the ETF. It's issued by Charles Schwab, a big US-based financial services company that have many different divisions, one of them being the ETF division. So yeah, basically SCHD stands for the Schwab US Dividend Equity ETF. And here you see the expense ratio. That's always something very important to look at because a lot of people just invest into an ETF because they see nice returns, but they often neglect to look at the expense ratio, and that can really start eating into your profits over time. So very important to look at that. And honestly, 0.06% is really quite low. So I get the appeal of that ETF. And as they write over here, the main objective of the fund is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. So that's what it's all based around. And then I was looking up how that index is calculated because the S&P 500, for example, is based on market capitalization. So the most valuable company is going to be at the top, which is Apple, and then the least valuable of the 500 will be at the bottom. And that will give you the weighting out of the total amount. So basically, if Apple is worth 2 trillion and all 500 companies together make 100 trillion, let's say, so Apple would have a weighting of 2% out of the total pie of companies. So here, when we look at how the Dow Jones Dividend 100 is composed, basically, as per S&P Global, it says the Dow Jones is an index family measured by the performance of dividend-paying companies in a suite of global, regional, country and thematic indexes. So you can see it's already a bit more complex. Indices contain stocks meeting specific criteria such as size, dividends and liquidity. The indices then are weighted by dividend yield, indicated annual dividend yield, so that's the upcoming one, country yield and float of adjusted market capitalization. I mean, you can see it's definitely less straightforward than the S&P 500. There are a lot of different factors and components that go into making the list of companies qualifying for the index, but essentially it's a combination of market value of the company and the dividend paying history and outlook for the future. Now that's all well and good, and definitely the world didn't wait on my video on SCHD because as you saw, there's already so much content out there about that. You can look it up yourself. However, the issue that I as a European investor have, as well as many other country investors, especially from the UK and other parts of the world, basically non-US residents, we actually cannot buy the SCHD ETF. If you head over to your broker and put the ticker symbol in there, most likely you will not be able to find it. And the same is true for many other US-based ETFs such as VOO, the Vanguard S&P 500, which I would love to own because it has a much lower expense ratio than the one equivalent that I buy, which is the VUSA, which is still attractive, but just not exactly the same as VOO. And the same is true in this example. Sadly, we cannot buy it in Europe, UK, and once again, other parts of the world. So the question is, what can we do about it? Now, I did find a great article about this. I'm going to put a link to this article in the description below. And the author here actually highlighted 15 dividend UCITS ETFs. That's actually the ones we have to buy as European or UK investors. Basically for Europeans that closely follow the SCHD ETF. So obviously you can read through it over here. He kind of goes through the whole process, what it includes, etc. And then in the end comes to a list of potential ETFs that you can buy in order to mimic the SCHD ETF. Now here you see some of them, but obviously already what stands out for me is the management fee, which is significantly higher than we've seen previously from 0.06. Most of them are 0.38, 0.65 even. But yes, you have to check it out, and not all of them are tax advantaged or exactly mirroring the SCHD. When I did myself look up on Just ETF, which is a great website to find ETFs you're looking for, to look for an ETF that follows the Dow Jones dividend while at the same time being based in Europe, I only came up with one over here, the iShares from BlackRock. But the issue here is it only has a fund size of 360 million, which is actually really low, means there's very little volume. So if people not particularly selling in a given day, you might actually have issues to liquidate your holdings, or it might be at a higher price because there's less supply. So for me, always important to look at the fund size as well. So as you can see, there are always options. So you could either choose one of those ETFs and then invest in them, or what I actually prefer to do, as I'm a dividend growth investor, I like to invest in individual companies, because an ETF is basically a collection of companies mixed together, and you buy the index, the average out of those companies. So if you're a bit more active and enjoy investing and reading on companies, why not directly invest individually into some of the top holdings of the ETF? So the question is, what are the top holdings of that ETF? And I think in general, you should always analyze at least the top 10 of your ETF, because sometimes we are so blinded by just investing into the market, but we forget about that it's not a stock market, but a market of stocks. So all your ETFs are individual companies. So with this, let's have a look what SCHD is made of. Basically, you can see currently they have 104 holdings in total, assets under that ETF of 46 billion. The top 10% make up 41% of the entire ETF. For me, obviously, I'm not going to look at all 104 companies. The same when I invest into the S&P 500. I'm not going to study the 340th biggest company in the stock. I really focus on the top 10, 15, maximum top 20. And really want to know what I'm investing the majority of the money in. Right, so here you can see immediately the biggest company by weighting. Starting with PepsiCo, which currently has the highest weighting of 4.47%. Now personally, I really love PepsiCo. At first I started investing in Coca-Cola and I thought I'm going to buy either or. But now, having recently listened to PepsiCo earnings call and analyzing their results and their future, I really see huge potential in the company. They also just became a dividend king, which means they have been increasing their dividends for the last 50 years, which is amazing. And they actually have so much more than just beverages. They also have all the snacks, the big chips company, and so much more. A really behemoth food and drinks company, which honestly I'm quite excited about. Currently the yield on PepsiCo sadly is a little bit low for me, 2.41%, but honestly then again, for such a compounder over time, actually really not too bad. You can see the market cap is 262 billion, which is around 10% of Apple. So they still have a long way to go given, the size and offering they have. Then we have AbbVie, which is also on my watch list. It's actually a big pharma company. AbbVie is yet another dividend company, have been paying and growing the dividends for over 50 years and currently pay a very attractive yield of 3.92%. Recently though, they have been dipping a little bit because with pharma it always depends on certain litigations or cases against the company, some legal claims. So that can temporarily lower the price of the stock, but long term, as you can see, with such a track record of paying dividends, they've really been doing well. And honestly, I'm quite excited about the company. Currently, as you can see here, it's in the middle of the 52-week range, getting much more attractive with a PE of only 13. Then of course, we have another legendary company, Coca-Cola, which I am invested in, but definitely I want to grow my position in it. At the moment, it's quite richly priced, I think. I hope there will be a little reset, because right now, with the markets taking a turn for the worse, a lot of investors are fleeing actually into the stable dividend paying stocks. And that's why right now those are more valued sometimes than some of the tech companies. So people selling out of tech and investing into those boring dividend growing stock companies. That's why companies like PepsiCo, Coca-Cola currently are quite richly priced in my opinion. Then we have another few companies like Merck & Co, Chevron. Always interesting about investing into oil, right? A lot of people are saying oil is gone, there's no point investing in it. But when you actually look at it, oil is definitely not gone. They're still paying a very nice dividend of 3.58%. So while I wouldn't invest in them for the next 30, 40 years, I think for the next couple of years, oil definitely has a place in investors' portfolio. Now, you may not like it from an ESG perspective because you don't believe in oil, etc. for moral reasons. Well, if you do, then I also hope that you're not driving any cars or not taking any planes to fly around, because, often it's very easy to have these double standards where you say one thing when it comes to investing and what companies should do, but then personally people end up using those services and products. So for me, I don't really like this double moral, and a lot of people actually investing into ETFs, naturally going to buy some of those pharma companies, tobacco companies, oil companies. So if you really so concerned about it, then you should be 100% also following with your actions and not invest into most ETFs. Because if you invest in the ETF, there's a high chance that you're going to buy some of those companies that you might not be aligned with in terms of your values. And obviously a number of other companies. I'm not going to go through every single one of them. Pfizer is still the top 10. I really like Pfizer. As you can see over here right now, they're really low priced in the 52-week. They reached pretty much the lowest price they've been for the last year. Their yield is 4.22%, really attractive. And for me personally, I already have it in my blood system, so I might as well have it in my portfolio. And then obviously you can go down the list and see more companies over there. BlackRock, a company I'm really excited about, is on 15th place. And And then we have Altria on 17th place. And Altria is actually one of those smoking tobacco companies. Even though they're transitioning away from this, they want to be known as an inhaling company. So that sounds a little bit nicer, but essentially they are selling cigarettes or e-cigarettes, even though they are venturing into medical inhaling healing. Quite interesting moves. I've never been a smoker and I don't encourage smoking at all. I always advocate a healthy lifestyle. But then again, the company exists anyway. So if I don't invest, somebody else will. They are paying a dividend of 7.91%. So even right now, I'm thinking to start a small position in the company because yes, again, it's another company that may not be there for 30, 40 years in the future, but why not capitalize on a nice dividend growth? The stock has still been doing well over the last 10 years with a slight growth. So it's not a huge growth company. Obviously, the business is more in a decline state, but you are going to get compensated with a nice dividend yield, and eventually you can move your portfolio and invest in something else. So it's up to you, but it just shows by investing into SCHD, you're also going to be owning some of those. So as you can see, there's always a choice, even for us European or UK investors or anyone outside of the US basically, to participate in some of the amazing growth rallies and ETFs and stocks that they have over in the US. So the choice, of course, is yours. Do you think it's worth to pay a bit more in expense ratio and buy one of those UCITS ETFs? You can do that. There are options available for the UK, Europe and other parts of the world, and that's probably the easiest for most investors. Just kind of set and forget it. Have a recurring investment plan where every week or month you buy a certain amount of that ETF and start accumulating. Or do you want to take a bit more active role into your investment journey, which is something I like myself. I actually buy every single week. I do my homework. I check on Seeking Alpha, what's happening. I follow some of the well-performing ETFs, log on to websites I've just shown you to kind of see what are the top holdings of that ETF and then mimic it. Because obviously that ETF, the good thing by investing in the ETF, you don't have to follow every single day what is happening. Because right now, the list we saw is the list today. But in 10 years from now, maybe one of the companies, let's say PepsiCo, is dropping in valuation. So they will have a much lower weighting and fall, let's say, out of the top 10, top 15, top 20. But for you as an ETF investor, it wouldn't matter. You would just continue to dollar cost average your way into it. While me as an individual investor into that company, I would have to do my homework to prevent it from dropping my overall portfolio because they had a bad quarter. I'm definitely much more active investing, so you have to find what works for you. But one thing I definitely recommend you, always understand what an ETF is composed of. Because do understand an ETF is composed of individual companies. If you're really concerned into not investing into certain industries or sectors, then you should really not invest in most ETFs and really do your homework. There are obviously ESG friendly ETFs out there that only focus on green energy or good ethical companies. So there are options for that. But having said that, most big ETFs definitely include smoking companies, pharma companies, oil companies that some people may not be that excited about. Myself, I invest for financial returns. If they're listed on the stock exchange and millions of people from around the world invest in it, I see no reasons why I can't participate in the gain of the company. I may not personally like the company, like for example Coca-Cola. I don't use their products. I don't believe in all these sugar drinks, but I know so many people love them. So why wouldn't I invest in it if I see the company being successful and people enjoying the services or products? Ultimately, the choice is yours. Yes, it might take a little bit longer to individually research and build your own portfolio, but in the long term, you can also avoid some of the companies that actually underperform, because some of those 104 companies currently in the SCHD will eventually drop out and will be replaced by others. And some of those companies I would have never invested in the first place. Companies like Home Depot or Verizon Communications, for me, are not attractive companies to invest in, but if I would have invested in the ETF, I would have still owned them. So, you have to make your own choice, but it's good to know that we have the opportunity of making such choices, and we do have options in Europe, UK, and other parts of the world. In this video over here, I actually did a deep dive analysis on Coca-Cola company and why I'm quite bullish on them in the long term. I hope you enjoyed the video. If you did, please give a like, subscribe to the channel, means the world to me. As always, stay healthy, get wealthy, and I'll see you in the next one. Ciao.